Hey there. As I look on social media today, I see all sorts of posts about the Bank of Canada rate cut yesterday, which was 0.25% as a reduction. And a lot of those posts are talking about the impact that has on debt. And that is one of the most direct impacts. If you have a line of credit or a variable rate mortgage, then yes, with this recent change, those interest rates have dropped by 0.25%, which is helpful. What I don't see a whole lot of is what does that mean for my investments? So I thought I would take a couple of minutes and just touch on that at a high level. And I would say there's two main ways that an interest rate change impacts investments. The most immediate impact is on bonds. And in most balanced portfolios, about 40% of the investment is bonds and 60% stocks. If you're more growth oriented, you probably still have some bonds in the portfolio, but maybe it's only 15 or 20%. Either way, most portfolios have bonds, which I like to refer to as glorified GICs. You're essentially lending some of your investment funds to a government or a company, and they're promising to pay you back an interest rate over a specific period of time. When interest rates go down, the value of bonds goes up because the bonds that are currently being held in a portfolio may be at a higher interest rate than they are now available at today. So for example, if a month ago I was able to purchase a bond paying 6% over the next 5 years, well, now if I go to buy that same bond, chances are the interest rate that's being paid is less. And so a new person looking to buy a bond is willing to pay a little bit more for the one I purchased last month as opposed to the one that they could go out and buy today. So in general, a balanced portfolio or any portfolio that has bonds in it benefits from rate decreases. The inverse happens when rates go up, and that's why we saw such poor performance for bonds in 2022. The other way that interest rates can help are stocks, because all a stock is an ownership in a company. And so if I have a company like Apple in my portfolio, this is a bad example because it was the Bank of Canada that made the change. The US has not yet had a decrease, but they're expected to. So let's say Rogers, for example. The money that they have to borrow now just became a little bit cheaper as well. So consumers are not the only ones that benefit from rate decreases. Businesses also benefit because they borrow as well for infrastructure projects, new capital investments, and they borrow often to make those investments in their companies. So now borrowing rates just got a little bit cheaper. That's better for their bottom line, potentially better for their stock price as well. One of the minor factors involved in a stock price change, but saving money is always helpful. So those are a couple of ways that the Bank of Canada interest rate change may help a portfolio. And as we continue to see these potential decreases happening over the next year or so, it won't be a definitive factor in making sure that portfolios go up, but it certainly will be a positive. I hope that helps. And if you have any questions, feel free to send them my way.